The terms active and passive are often used to describe different styles of investing. While debate over the two strategies has always been hotly contested, it's becoming even more important in the wake of the financial crisis as investors look to restructure their portfolios. In this session, we'll define active and passive investment, identify the pros and cons of each approach, and outline recent and possible future trends regarding active and passive investment. Elizabeth Tilley presents this report.
Active and passive investing are often portrayed as two schools of opposing thought. Passive investing is where investors seek to build a portfolio that reflects general market trends. In its simplest form, a passive fund manager may buy shares in a standard market index, such as the S&P/ASX 200, in the belief that after transaction costs, it will provide the greatest returns over time. A passive approach towards investment relies largely on the efficient market hypothesis, which assumes that markets are correct in their pricing and have already factored in all available information. Russell Investment Senior Consultant Nick Curtin explains.
Effectively, passive investing is just a straightforward, almost blind buying of a standard market index, typical sort of cap-weighted index, be it the ASX 200 or Russell Global Index or pick your index, UBS Composite Bonds, etc. And it's really just trying to replicate the performance of the standard index that's in place.
In contrast, active investing rejects the efficient market hypothesis and assumes that market pricing is not always correct or reflective of the information available. Active investing aims to outperform the benchmark index as investors select specific stocks and shares based on meticulous research. It's the dominant approach taken by most fund managers and is usually associated with short-term investments such as currencies, futures or derivatives.
Effectively, an active portfolio is one where you're taking positions away from the index. So it's not buying some of the stocks that might be indexed, buying more of others, underweighting, overweighting, and taking an active position.
There are pros and cons to both active and passive investing. The main advantage of passive investing is lower associated costs, such as entry thresholds and trading fees. Plus, the potential tax impact is reduced as capital gains aren't realised as often. On top of that, governance costs are also lower. A passive approach is ideal for more conservative investors or those with limited time or tolerance for risk. On the downside, a passive approach can limit the potential for optimum exposure and reduce the ability for investors to take high conviction positions, as Leyland Asset Management's Charles Leyland explains.
The other key differences I would say are the style of management and the approach that the manager takes. Obviously with active, you're going to have higher conviction and the opportunity to perhaps have direct equities and have more specific mandates, whereas in passive you really have to be part of a fund and you haven't got the opportunity really to get outperformance.
Ideally, active investing is more suited to aggressive type investors, as it allows for greater market exposure and the ability to trade in high conviction areas. On the other hand, there are higher operating costs, such as fees and commissions, plus capital gains tax can negate the benefits of higher returns. Deciding which investing style is appropriate for investors really comes down to a client's risk tolerance, as well as their needs and objectives.
Because as soon as you go active, you run the chance of hopefully outperforming, but there's a pretty good chance you're going to underperform because you're building a portfolio that looks different to the index. So you need to have a tolerance for return outcomes that are different to the benchmark index. If you don't have a tolerance for that, well, you should probably stay passive. And it's just about understanding those tolerances and the sort of risk budget, so to speak, that the investor has. And it'll be different. That'll differ from client to client.
The ability to effectively identify good fund managers is also central to deciding which investment style is more appropriate for the client. By selecting well-performing fund managers, active investors can be rewarded with returns well beyond the market index. For instance, legendary US investor Warren Buffett is perhaps the ultimate example of an effective active investor. Between 1964 and 2004, Warren Buffett's company Berkshire Hathaway outperformed the S&P 500 index by over 50 times. However, many regard Buffett as the exception rather than the norm, and debate continues as to whether active investing does outperform passive investing, once fees and taxes have been removed from their profits. For Australian equities, in the 5 years to December 2009, the Standard & Poor's Index versus Active Funds scorecard found that the market index outperformed active funds. But interestingly, the research also found that in the year to December 2009, active funds did outperform the market index.
Most active managers underperform the benchmark, but the ones that outperform significantly. But the more detailed analysis, when you take into account the restrictions on what and the mandates that the active managers are given, the high conviction calls that they make are generally very, very good. It's the stuff that they're left with in their portfolios that can actually detract from the performance.
The ability to identify well-performing fund managers is central to the active versus passive debate. By getting that right and correctly identifying specific assets to outperform the market, active investors can be rewarded with returns significantly beyond the benchmark index. But given the cyclical nature of markets, there are still no guaranteed returns.
Yeah, the market index fell by 50% last year, so even if you went passively into the ASX, you still could have lost half your money. So, being passive is no guarantee of actually getting positive return. It just means you get the market return.
In the wake of the global financial crisis, there has been a shift towards planners using more simplified investment portfolios. But this isn't always the best approach.
Right when the market's down, they go into their shells and they just go into a passive or whatever it is. And when the market's booming and everyone's talking about how well things are, people actually get confident and they spend the money. So that's why they need to employ a manager who's been there, who's got the temperament, who's seen it all before and knows to buy when no one else is buying. And as Warren says, be fearful when others are greedy and greedy when others are fearful.
In light of investor nervousness, there have been a number of new investment trends in terms of active versus passive. The core satellite approach is an example of this. Charles Leyland explains.
What a manager might do if the mandate is to invest in the top 100 shares, say, he'll buy a core portfolio of that will broadly track that index, and then the satellite will be where he has a few high conviction ideas and will try and get the outperformance there.
This is a useful strategy for investors who wish to diversify over time, as it allows them to move their assets according to changes in their risk budget. Exchange-traded funds are also experiencing growth in the wake of the financial crisis. ETFs are diversified portfolios, typically designed to replicate an index. By purchasing a single ETF, investors can access a full portfolio of investments that can be easily traded, similar to buying or selling shares. In response to the debate over active versus passive investing, Russell Investments has released a 5-point framework to consider when choosing an alternative approach to passive investment. Of the 5 points, 3 of them refer to when there's no replicable index available, when the passive index is at odds with the investor's objectives, or when the index is inefficiently constructed. The final 2 points say an active approach should be considered when the investment environment favours active management and skilled managers can be identified. As the economy moves towards recovery, there are likely to be further developments in the active versus passive debate.
We think the environment's going to remain fairly conducive to an active approach. There's just, there's a lot of opportunity on the table, but again, that's subject to your ability to identify good managers. When the environment is good for active managers, it means the dispersion of return between managers is wider. So you need to be much more discerning and more confident in your ability to avoid bad ones and pick the good ones. So in terms of active and passive, in terms of tips, use them both, use them appropriately, and most importantly, use them for the right reason.